presidents, vice presidents over here. We have our faculty in charge too, Mr. Vicky Karnani, and if you can hear me. So over to you, Karishma.
Yes, thank you, ma'am. I would like to introduce Miss Everyone and Mr. Tirth Gala. Thank you for giving me the opportunity. In the tapestry of our daily lives, there is quite force shaping our future finance, financial management, and financial planning. This evening, let's step into the real life scenario where this knowledge becomes our compass to achieve the future we want. Imagine this webinar as our passport to financial freedom, a roadmap to navigate the twists and the turns of monetary landscapes. Good evening to one and all present here. I'm delighted to present Mr. Tirth Gala, an accomplished alumni of HR College, a chartered accountant with an outstanding All India rank of 43 and CFA level 3, with a rich professional background, including roles at KPMG and Anand Rathi Wealth Limited. Mr. Gala currently holds the position at the partner Moksh FinServ, a distinguished firm ranking in the top 0.1% in the country for assets management. Beyond this professional achievements, Mr. Tirth Gala is a passionate photographer, avid traveler, and a dedicated tennis enthusiast. Before we commence, I would like to express gratitude to our principal, Dr. Pooja Ramchandani, our professor in charge, Ms. Shweta Singh, and Mr. Vicky Karnani for providing us with the platform to conduct this insightful session with Mr. Gala. Thank you. Now, let's extend a warm welcome to Mr. Tirth Gala as we eagerly anticipate the insights he will be sharing with us today. Thank you. Over to you.
Thank you so much, Karishma. I would also, like to start by first thanking HR College, Pooja ma'am, Shweta ma'am, especially for arranging this session and coordinating with me. So I remember, when I was in FYJC in HR, a similar sort of session was arranged for us where a gentleman had come in and explained to us the importance of personal finance, investing, and how do you go about, getting into that journey. And that engroused my attention. It got me involved into investments, into finances, and it basically led me to where I am today. And that is the hope with which I start this session, that maybe I can motivate somebody over here to understand and to learn from what magic finances are. Right. So the first thing that I would like to start with is something known as the rule of 72. I'll just share my screen. Yeah, I hope this is visible.
Yes.
Okay, perfect. So this rule of 72 is basically the rule of doubling of money. This basically tells us that in what time or at what rate can I double my money. So the rule is basically 72 divided by I, that is the rate, is equal to N, which is the number of years. So let's say I am growing my money at 12%. So in what number of years would my money get doubled? So 72 divided by 12 is equal to 6 years. So if I'm investing 100 rupees in any asset, and it is giving me 12% return on a compounded basis, in 6 years, that 100 will become 200. Now, this can also be used in the opposite manner to calculate what is the rate of return that I need to earn. So let's say, for example, I want to double my money in 5 years. So 72 divided by 5 is equal to 14.4. So if I grow my money at the rate of 14.4%, in 5 years, I will have ended up doubling my money. So this is something that can be applied in any form of investment or in any sort of situation in life, or even in your accounts. Let's say I want to double my sales in 5 years. So again, you divide 72 by 5, you get 14.4. So you grow your sales at 14.4% every year, and your sales will get doubled in 5 years. Right now, this is a very theoretical thing that we've seen. Now, applying this to the real aspects of life, how does this actually matter? What kind of difference can this actually make in your own finances? So let's say most of you would be somewhere between the age of 19 to 20 or 21. So you will have the next 30-35 years wherein you'll graduate from college. You'll maybe do some further studies, some will start working, and you'll have the next 30-35 years of your life to work, to build wealth, to generate, to satisfy your goals. So let's say you have the next 35 years to build money or to generate wealth. And you are investing in any asset class that is giving you 6% returns. So in what number of time can I double my money? So 72 divided by 6 is equal to 12. So my money will get doubled every 12 years if I'm growing it at 6%, right? So if I have 35 years, then, and my money is doubling in 12 years, then over the period of those 35 years, I can double my money 3 times, right? In the first 12 years, I can double it. The next 12 years, I can again double it. And the last 12 years, I can again double it. So if, let's say I start with 1 crore rupees in 2023, by 2035, 1 doubles to 2. By 47, 2 doubles to 4. And by 59, 4 doubles to 8. Now, at the same time, if I look at any asset class which is growing at somewhere around 12% instead of 6%, then in what period of time can I double my money? Right. So again, 72 divided by 12 is equal to 6 years. And if I'm doubling my money in 6 years and I'm investing for a period of 35 years, I can double my money 6 times. So if I'm starting with 1 crore rupees today, 1 crore becomes 2, 2 becomes 4, 4 becomes 8, 8 becomes 16, 16 becomes 32, and 32 becomes 64 crores. In the same period of time, where one asset class is giving me 8 crores, another asset class can give me 64 crores. So the difference is not of 2%, 3%, 5%, or 6%. The difference is 8 times of the money that you can make. I mean, isn't this phenomenal? The kind of impact that this compounding, compounding of numbers brings into us. You know, this is the reason why Warren Buffett, who started investing at the age of 11, says that, you know, I started too late. If I started at the age of 6, today his wealth of $100 billion would have been $200 billion. So that is the kind of difference that just selecting the right asset class can bring into your entire life, into your financial journey. Right? Any questions on this? Everybody is good with this? Any views that anybody has on this? Fairly simple, fairly good to understand, right? Yeah, great. So invest, you know, these things are fairly simple to understand, but very few people actually do this. You know, it's just like exercising. You know, everybody knows that to be fit, to be healthy, you need to avoid oily food, you need to avoid sweets, you need to exercise for 30, 45 minutes a day, and you can be in good health. But a very few people actually end up doing it. It is very simple to understand, but it is very difficult to implement because it requires patience, it requires discipline, which most of the people are not able to sustain for a longer period of time. Right. But by not doing that or by missing out on this, what is the kind of difference you're missing out on over the longer period of time? So let's say I'll just show you another similar calculation. So this basically shows us what is the importance of starting early as far as investments are considered. Now, I know, you know, most of you are still in college, you're still studying, you don't have a source of income to invest. So you might think that this is not applicable to us. We'll think of this when we start working, when we start getting a salary, we'll think of investments at that point of time. But uh, I'll be very honest, at that point of time, it will become too late. You have to get the habit of investment from now. It may be, 1,000 rupees, it may be 500 rupees, it may even be 250 or 300 rupees that you can invest on a per month basis. But if you do it from now for the next 2-3 years, you'll develop that habit so that when you start earning real money, when you start working, you'll be already on a good level. You'll already be up the slope a little bit. Now, let's say let's see what this data shows us over here. So let's say we have two individuals, Mr. Aj and Mr. Kal. They are both from HR college. They are best friends studying in BFM TY. They completed their graduation. They started working at the same time. Mr. Aj said that as soon as I start working, I have to start investing. Mr. Kal said that, I want to live my life here. For the first time, I'm earning my own money. I'm not dependent on anybody. I want to, roam the world. I want to buy things that I love. I don't want to think of investments at this point of time. So Mr. Raj started investing. Let's say he starts investing about 40,000-50,000 rupees a month, which is approximately 5 lakh rupees a year. So in 6 years, he keeps on investing 5 lakh rupees every year. And this 5 lakh rupees is growing at a rate of 12%. Now forget wherever he's investing. Okay, he's just growing it at 12% somewhere. Okay. Now, at the end of the 6 years, after having invested 30 lakh rupees, the amount stands at about 43 lakhs. Now, at this point of time, Mr. Kal says that, wow, my friend has accumulated 43 lakhs. I should also start investing. I should also start looking at this. I mean, things are getting real in life. My goals are coming in, my expenses are coming in, my responsibilities are coming in. So, from the seventh year, Mr. Kal also starts investing 5 lakh rupees every year, where Mr. Aj stops investing absolutely from the seventh year. So he's only invested for 6 years. Now, if we look at their situation at the end of 25 years, so Mr. Aj has only invested for the first 6 years, 5 lakh rupees every year. So a total investment of 30 lakhs. Growing at a rate of 12%, at the end of 25 years, this becomes 3.7 crores. Mr. Kal, on the other hand, started investing at the seventh year, 5 lakh rupees every year. And he did it for the next 18 years. He kept on doing this for the till the end of the 25th year. So he invested a total of 95 lakh rupees. And at the end of the 25th year, his portfolio still stands at 3.3 crores. Although they are both growing their money in the same asset class at 12%, even after 25 years, Mr. Kal has not been able to catch up to Mr. Raj. Now, why does this happen? Because he missed out the initial 5 years, which are the most important years in terms of investments. If you miss out on those 5 years, you're never going to be able to recover them in the future. So if you look at the picture at the end of 25 years, Mr. Raj has invested only 8% of his entire corpus of 3.7 crores, and 92% has been generated by his investments, while Mr. Kal has invested 28% of his entire corpus, and only 72% has been generated by his investments. So this is the importance of starting early. This is the importance of taking these decisions and implementing them in your life at an early age, right? Any questions on this? Any views on the sort of math that we are seeing here? And again, this is pure simple math. I mean, you can put these number into Excel yourself, just compound it at 12%. We all know the formula for compounding. Just do it and you will see the results. I mean, we've been doing this since school, 1 plus C into 1 plus R raised to N. Do it for real. Understand the implication of this. The R is not very important. The C is not very important. What is important is the N. The N is the most important figure in that formula. So how much ever you can increase that N is going to determine how much can you increase your total portfolio or your total corpus. Right? Any questions?
Students, you may ask any questions if you have. We can have it as a very
Any
interactive
views on this? Everybody's good? Understands, right? What is compounding? What is when I'm talking about rate of returns, how is that calculated? What are the figures that we're talking about? Any sort of questions you can feel free to ask, or you can even share it on the chat.
If you don't mind, can I ask a question? So when you're talking about the importance of starting early, as a student, I'd rather would like to ask what factors are we supposed to consider? What research are we supposed to do with the basic knowledge of finance that we have to start our journey? Because as you likely said, that you have to start early and as early is better. So what factors should we consider?
Right. So by factors, you mean what sort of asset classes should you look at, or what are the things that should be influencing your decision in choosing where you're investing?
The kind of asset classes we should start researching on so that we understand, because at a younger age we tend to have a bit of more risk taking capacity. So
Right.
how should we go about our journey?
Right, sure. We'll come to that. So I'll come to the asset classes in a bit. I will cover that in 10-15 minutes. Right. We'll talk about what sort of asset classes are available in the market today. What you should be looking at when you are trying to judge which asset class to get into, and what is risk, what is return. Right. But this was just to give a understanding on why investments. Do you, the first decision that you need to make is, do I want to invest? Do I want to put my money somewhere? Do I want to grow my money somewhere? Right. So this is the importance of taking that decision to invest. The decision on the asset class will come at a later stage. Okay. Okay, great. Right. Now, right. Now, okay, so let's cover, is it possible to generate 50% yearly returns? Okay, Meet Bohra. Sure, you can. There's something known as a casino in Goa. You can go there, put your money, it can double. You can generate 100% returns also. Right. Okay. So when we talk about asset classes across the country or across the world, there are four basic asset classes from an investment point of view. Right. One is equities, another is debt, third is real estate or property, and fourth is commodities, gold, silver, other metals, petrol, crude, things like that. Now, when we are talking about investments, what you usually look at is three things. One is the return, second is the risk or the volatility, and third is basically the ease of doing business, the transparency of the asset class, or the ease with which you can invest and take your money out, or the flexibility that it offers you. Okay, now let's say we first look at equities as an asset class. So what is the return that you usually see in equity? It's somewhere around 12 to 14%. If you're looking at basic Nifty or basic Sensex, that is the kind of return that they've given you over the last 25 to 30 years in India. The risk again depends on the time horizon that you have. The volatility over a 1 day or a 1 week or a 1 month period will be very high in equity. But when you look at the volatility over a 4 year or a year period, it is very dependent on what you look into equity. Now, within equity also, there will be very different sort of investments that you can look at. One is you directly invest into shares through Zerodha, through Grow, or any security broker. Another is you go through mutual funds, where you do a SIP or you do a lump sum investment. Another is you go through a PMS, which is a portfolio management service that a lot of big houses provide. So the ease of doing business depends on the asset class that you choose. Now, what I have seen or what I have analyzed is the ease of doing business is the highest in mutual funds as of now. Right now, I, being a financial advisor, don't love any asset class. I don't love mutual funds. I don't love equities. I love money. So wherever I can make the best amount of money with the lowest risk and the highest flexibility and ease of doing business, I'll invest my money over there. And that is where I currently do my investments, and that is where I currently recommend investing, that is into mutual funds. Now, this can change over a period of time. Maybe 5 years or 7 years down the line, government starts regulating crypto, government starts regulating the other exchanges like Bitcoin or Ethereum, and I'll start recommending that. But as of now, when we are looking at all the asset classes from a risk, return, and ease of doing business perspective, mutual funds stand out. We are seeing 14, 15, 16% returns across the last 15, 20, 25 years of investments. So that is about equity. Moving on to real estate. Again, here, the returns that you see will be somewhere around 8 to 9%. The risk would be somewhere about 5 to 6%, depending on the market situation. But the problem over here is the ease of doing business. It is very, very difficult to go and buy a property, and then even more difficult to sell off that property. Whenever you go to I mean, you're still pretty young, so you don't, most of you would not have gone through that process. But when you usually, go to buy a property with a set of documents, the broker will say that everything is good. Yes, we can, go ahead with the transaction. When you take the same set of documents and ask that, I want to get out of this property, I want to sell off this property, he'll always say that, one document is missing, this is missing, I need that, we need this permission. So the ease of doing business is very difficult in real estate. And the third is debt. Here again, the ease of doing business is very good. The risk is not at all very high. It is 1 to 2% volatility, but the return part over here is very low. It gives you somewhere around 5 to 6% of returns, right? If you look at FDs, if you look at government securities, they're currently yielding 6.5%, but that does not even beat your inflation, right? The inflation in India is more than 6%. That is the CPI inflation. The CPI inflation basically takes into consideration that 50% of the entire expense goes into food or edibles or eating, the basic grocery part of your house. But for most of us, 50% of our earnings would not be going into food and groceries. Most of the expenses are more in terms of your lifestyle, where you go for holidays, the restaurants, the movies, buying clothes, going on vacations, buying cars. So the inflation that is impacting us is not the CPI inflation, that is the lifestyle inflation, which somewhere stands at about 7.5 to 8% in India for the last 15 to 20 years. So if the lifestyle inflation is growing at 7 to 8%, I cannot be investing my money in any asset class that which gives me less than 7 to 8% returns, right? Because if I'm investing in an asset class which is giving me, let's say, 6% return, and my inflation is growing at 8%, every year I am losing out 2% of my money, right? We understand the concept of inflation, right? We've been learning that since FYJC, and that's the basic purchasing power of money. So if I have 100 rupees today and I'm not spending it and I'm just keeping it, and in India the inflation is somewhere around 8%, then in the next year, with that 100 rupees, I'll only be able to buy things worth 92 rupees today. So I'm essentially losing out on 8% of my entire corpus, right? So if I keep on doing that, if I am not beating inflation with my investments, what I'm essentially doing is I'm wiping out my money. I am losing out on my money. Rather, I just go and spend it. I mean, if you're not investing your money with the inflation of 8%, if you apply this to the rule of 72 that we just went through, 72 divided by 8, which is equal to 9. So in every 9 years, your expenses are doubling. So if I am, keeping my money idle, if I'm not investing it anywhere, within 9 years, essentially half of that money is useless. My 100 is becoming 50 rupees within a matter of 9 years. Right. So it is very, very important to beat inflation as far as investments are considered. Right. So that is on the asset classes. Any questions on this? Any views? Or Sonal, does that answer your question, or uh, more clarity is required?
No, that fairly answers to my question. Thanks. Cheers.
Okay. So what do you think? I mean, what sort of an asset class should you be looking at?
Right now, with the way I think the market's working and how the country's economy is going per se, stock market looks pretty tempting. And I think yesterday the news came out regarding FNO's this thing that short selling started and
Right.
futures.
Right.
Yeah. So I think it's a pretty tempting area to look at. So with
Sure.
that,
Sure. Sure. Great. Yeah. So it is quite tempting, to especially with the sort of technology that we have today with Zerodha, with Grow, with all these sorts of app wherein you can just upload your PAN card, you can make an account, and you can just start investing. You can buy Tata, you can buy Reliance, you can buy futures and options. But the more important part over there is to do your studies. I mean, to realize what we are getting into. I mean, if you open Zerodha today, I'm not sure how many of you actually trade on a lively basis, but if you open Zerodha today, the first thing that it shows you is 9 out of 10 investors that invest into options lose out their money. right? Even the 1% that are making money are actually paying more to apps like Zerodha in terms of brokerage, right? So this has become a very big fad in today's generation. I mean, it is wrong to classify it across the entire generation, but it has become a very big market today, the FNO, especially with the financial influencers. You just type on YouTube how to make profits, how to do investments. They'll show you all sorts of technical charts कि candle इतना ऊपर गया तो अगले दिन इधर जाएगा, फिबोनाची सीक्वेंस देखो,
Yeah.
शोल्डर बन रहा है उल्टा, हेड एंड शोल्डर्स pattern is forming up, so
True,
this
true.
stock is looking good.
Yeah.
Yeah, absolutely. But what is important over there, that is why SEBI is completely after them. Every 2 weeks,
Correct.
every 3 weeks, they're coming out with a new rule to stop them because they're essentially spreading nonsense across the entire country.
Correct.
There's just no stopping them, and people are looking at the market returns over the last 1 month, 3 months, 6 months, 1 year, 3 year. They don't realize that there were periods in the markets, long periods from 2018 to 2020, wherein the markets did not go anywhere. They did not
Correct.
give you even 10% returns. And
Yeah.
during that point of time, how is your behavior going to be? If you're investing all your money into shares, into options, are you going to be able to sustain yourself? Are you going to be able to hold yourself when you don't see returns coming in for, forget a month or 2 months, but for 2 years, 3 years? That is the reason people actually don't make money in equity. If you look at the average holding period for a mutual fund scheme, that is just 2 years. I mean, can you imagine something like a mutual fund where everybody says that, it is risky, you invest for a long period of time, you look at your long-term goals, but the actual average holding time is just 2 years. If you're holding it for 2 years, how are you going to make money? We just looked at that formula of 72, to make 64 crores, you're going to require 35 years. It is not so easy कि 2 साल invest किया and we become a crorepati. Warren Buffett made 90% of his wealth after the age of 60. And that is why he said that 11 की उम्र में भी मैंने चालू किया तो it was too late. I should have started at 7 ताकि by the age of 55 I should have made more than 90% of my wealth. So that is about, it is more about your own personality. It's more about your behavioral quotient, the discipline, the patience, the consistency that you can have in terms of your investments rather than just looking at the return. Right? It is very important to not get carried away by a 40% return that I'm seeing in small cap schemes or in the small cap index in the last 1 year. It is important to look at asset allocation, to look at what is my risk taking ability, what are my goals over the next 4 years, 5 years, 6 years. And those are the things that should influence my investment decisions, not some guy who is coming in and, who's a BCom pass and telling me what to do for my life's savings. Now, another thing that, I'll touch upon three very big mistakes that people usually make in terms of equity investment, equity investing, right? So the first one over there is the timing. A lot of people think that I can outsmart the market. Abhi market बहुत ऊपर भाग गया है. I'll book some profits and then I'll again re-enter when it comes down. Right? Why is this very, very harmful for your investments? Right. So, yeah. So if you look at this data, this is very, very interesting data that was compiled by your organization. So this basically tells us that in the last 18 plus years, if you look at Nifty 50, and you've been investing for the last 18 years. So if you've invested in 2005 and you've not removed your investments for the next 18 years, your 10,000 rupees investment has given you a 14% return and it has become 1.15 crores within 18 years. Now, let's say over this period of entire 18 years, I've missed just the best 5 days. So across 18 years, which is somewhere around 3,000 to 5,000 days, if I just miss the best 5 days of the market, my return comes down from 14% to 11%. And my value of my portfolio comes down from 1.15 crore to 75 lakhs. So 25 lakhs or 25% of my entire corpus is lost if I miss just the best 5 days in the market. And that is what happens when you try to time the market. You end up missing just 5 days, you lose out on the biggest chunk of your investment. If you end up losing just the best 10 days, your return comes down from 14% to 9.5%, and your value of your investment comes down from 1.15 crores to 54 lakh rupees. So you've essentially lost 50% of your entire portfolio just by missing the best 10 days over a period of 18 years. Not 1 year, 2 years, or 3 years, but 18 years you've invested, and you've just missed the best 10 days, and you've lost 50% of the entire portfolio value that you could have created. So that is why timing in the market is something that is very, very horrific. It is essentially something that you should not be touching, or you should not be looking at, unless you have a very good professional view to back it with. Right. Another thing is, people are very scared of volatility. They think, market में क्यों पैसा डालना चाहिए जब ऊपर नीचे इतना होता रहता है. Now, when we are talking about a long-term investment, volatility is actually very, very beneficial to you. Now, why is that? Right? Because we are not investing all the money that we have today into the market at a single point of time. So let's say if I start my investment journey, sorry. Yeah, so let's say I start my investment journey in 2023. I'm not going to put my entire life's saving into investments in 2023 and then see the 2050 may I'll take that money out, because I'm going to keep on working over a period of 20-25 years, and slowly, steadily, I'm going to keep on investing as I'm able to save, and I'll invest that money, into the market or into equities or into any asset class. Now, why would that asset class or the returns of that asset class going down or going negative be beneficial for me? Right, I'll just share another calculation. So yeah, so this basically tells us why is volatility good for you. Now let's say we are investing into any market which is at 1000 rupees today in year one, and we are investing 1 lakh rupees every year into this, and this market is growing at 10% every year. So 1000 ka it becomes 1100, 1100 becomes 1210, 1210 becomes 1331. So by 10% this is increasing every year, and at the end of 15 years this becomes 3797. And my investments are not going to be all in year one. It is going to be spread out over a period of, let's say, 15 years. And I'm investing 1 lakh rupees every year. So let's say in the first year, I invest 1 lakh rupees where the market is at 1000. So I get 100 units. So 1 lakh divided by 1000 is equal to 100 units. In the second year, again, I'm investing 1 lakh rupees, but the market has moved up by 10%. So I am essentially buying something that is more costly. So I'm buying it at 1100 rupees, and the units that I will get will only be 90.91. Likewise, as the market keeps on growing, my investment is going to give me less number of units. So at the end of 15 years, I'm going to accumulate 836 units, which would be worth 3,700 each, which will make my investment at 31,77,000 rupees. But which basically means that I've made 8.92% returns when the market has actually been going up at 10% every year. So if the market keeps on moving as a single slope, if it keeps on going up, 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 and up, your investments are not going to yield that same set of returns. That is why volatility in the market is very, very important. You will make more money when you invest when the market is going down. So when the market moves from year to year to year to year to year, that is when you will make money, not when it just goes from year to year. So volatility in the market is actually something that is your friend, that is going to make those sort of returns for you. Right? Any questions on this? Any views on this? All clear till now? Am I going too fast, or everybody's able to understand?
Good, good.
Okay. Great. Right. Now, so that is, about investments, about the basic principles of what volatility is, what asset classes you would be looking at, uh, how you should be looking at your investments from a long-term standpoint, how the rule of 72 is something that is going to compound money at such a high pace that you're not even going to be able to understand. Apart from this, one more thing that I would like to touch base upon is diversification. So this is again a very big myth that is running around the country, saying that, don't put all your eggs in one basket, don't put all your money into a single asset class. But why is that so? I mean, if I am able to identify an asset class which is within my risk appetite, which is within the returns that I'm getting, which is easy for me to invest into, which is transparent enough for me, why should I not put all my eggs into that basket? I mean, if India is going to grow, is not the market going to grow with it? I mean, we've all studied the theory, right? Real GDP growth of the country plus the inflation plus the dividend yield. That is what the overall growth for the economy is. And when the economy is growing at a certain rate, that is the rate of return that we are going to see in the overall markets for that country. Because at the end of the day, what are markets? Markets are basically just a list of companies or a group of companies that basically mirror the entire country. The Tatas, the Birlas, the Reliances, that is what make up the country. When the GDP is growing, when the inflation is growing, so are those companies going to grow. And when those companies grow, when their profits grow, when their balance sheets grow, so are their share prices, right? So why do we say, Modi ji is also saying that we are into Amrit Kal of Bharat. This is the decade of India. This is the golden decade of India. This is the time in the country. This is, if you look at it from an economical standpoint, uh, the very basis on which most of the economies across the country have grown, across the world have grown. If you look at Japan in 1980s, if you look at the US in 1990s, if you look at China in the early 2000s, all of them have been through the similar phase of cycle, the similar economic cycles, when the GDP per capita of a country has passed $2,500. Right? Japan did it in 1980s, US did it in 1990s, China did it in 2000s. India has just crossed that. India has just reached $2,600. That is a GDP per capita, which is basically the total GDP for the country divided by the total population of the country, which basically tells us what is the average contribution that an average Indian is making in the country. Right. So when that crosses $2,500 in any country, the growth of that country happens like a hockey stick. It is not a flat line growth. It is not through 2%, 3%, 5%, or 6%. It happens like a hockey stick. It goes straight up. I mean, the things that you see are phenomenal. You see 10%, 12%, 13% growth coming in. That is what we are seeing in India as well. If you look at the real GDP growth, that is somewhere around 6.5%. The inflation being at about 6 to 7%. You add 1-2% of dividend yield. So the overall growth for the economy is going on at about 12 to 14%, which is phenomenal. I mean, and you can see that in the country, right? You look at the Cricket World Cup that was just held. We spent 47,000 crores in a matter of 2 months. I mean, if you look at the Ahmedabad airport, there were so many private jets coming into the airport that there was not enough space to park them. They literally had to drop people off like you do in a taxi and go into another airport to park the private jets. That is the amount of private jets that were there in the country at that point of time. That is the sort of growth that we are seeing in this country. I mean, 200 new airports are coming into the country. I mean, it is happening everywhere. It is phenomenal. If you look at, let's say, 15, 20 years earlier in the country, the basic domestic situation was such that, there was one father in the family who was working, who was earning income. There was a mother who was supporting the house, and there were children who were still studying. Today, if you look at the same house, the father is still working. The children have gotten out of the education system. They've also started working. And a lot of females in the country who were housewives earlier have also started doing some small business, started getting educated, started contributing to the overall economy. So when that is happening, the income of the household is essentially becoming 4 times. So when the household income 20 years ago was, let's say, 20,000, today it is becoming 80,000. So when the household income becomes 4 times, where does that money go? It will not go into your basic needs. The roti, kapda, makan is only going to require so much money. You are not going to start eating 10 rotis and 15 rotis because you're earning more. That extra income is going to go into your lifestyle. It is going to go into white goods, ACs, refrigerators, bikes. People who are riding cycles are buying bikes. People who bought bikes are getting into small cars. Small cars are buying sedans. Sedans are going into SUVs. SUVs are buying Mercedes and Lamborghinis. And people who were buying Mercedes earlier are now buying private jets. That is why we are seeing so much traffic at Ahmedabad airport. I mean, that is the sort of direction that the economy is headed into. And this is what is actually happened in 3, 4 countries before us also. And this is this is the period where you take advantage of it. Once this period passes, which has happened in the US, which has happened in Japan, once that period gets over, you will not see this growth. I mean, you will not be able to earn 12%, 14%, 15% returns. And when you're not able to do that, you will not be able to compound your money at 72 divided by 14 is equal to 5 years. You'll take 7 to 8 years. So if you're doubling your money in 8 years or 9 years instead of 4 years and 5 years, we've seen the kind of impact that it has on the end goal that you have. Right. So that is about the Indian economy as well. Any questions on that? Any questions uh in general about personal finance or investments, any sorts of those things? Yeah, Stuti.
Yeah, so as you mentioned about the growth of the economy in India right now, so I totally agree with you about that. But I wanted to know, like, I read recently somewhere that India has above 100% debt over it. So how is this growth and the debt, like, how are they connected? Like, if the country is facing or is under debt right now and it is still progressing, so is this a good scenario for the country or not?
Sure. So, from an economic standpoint, debt and the growth of the economy or the growth of the country is not linearly related. I mean, just because a country has a higher debt does not mean that that country will not grow. Do you know which is the country with the highest debt in the entire world? Just a random
Mm,
guess, just a wild guess.
No knowledge as such about that.
It is the US. So US currently has $17 trillion of debt, but it is the most developed country in the world. It is the country where the most business is happening. It is the country with the most per capita income. It is a $66,000 per capita income. People are living amazing lifestyles. They are making amazing money. So the debt of the country is not related to the economic growth of the country. The debt will surely have adverse impacts in terms of, let's say, the rupee situation, the rupee dollar transaction value, or the government's situation. But a higher debt basically tells us that what the government is doing is it is borrowing money and it is utilizing it. It is borrowing money from the IMF or the World Bank, and it is making infrastructural projects in the country. When the infrastructural projects are coming into the country, people are getting labor, people are working, infrastructure is getting developed. India is moving towards a developed economy. That is the goal that the Prime Minister said, that by 2047 we want India to become a developed country. So debt and the growth of the economy are not linearly related, to answer your question in short.
Understood. Thank you.
Right. Any other questions, any other views? I mean, that's most of the crux that I had from my part. But if there are any other things that you would like to ask, or you would like to like me to go through, sure. Okay.
If you may, can I ask a question? Right. I know it's a bit digressing to the main theme of this topic, but when you talk about personal financing, in somewhere down the line, we all want to kind of own a house or maybe a car, the physical assets per se. So, looking at today's India trend Indian trend, would you say that we are inclined to buying more houses or investing it, or rather renting them out at today's level? Or
So
rather in future down the line, we'd rather rent than own a house? Because most of the developed countries right now are at that stage.
yeah, absolutely, absolutely. So this is, a very emotional topic, especially in a country like India, housing and gold. These are the two things that I always try to avoid whenever I'm talking to a prospect or a client, especially when we are sitting in a family, if I'm sitting with his family, because it becomes very emotional. A house, where you've grown old, where everybody wants to have a house. As soon as you start working, a lot of parents tell you that अब घर खरीद ले, अब settle हो जा. But if you look at it, keeping the emotions aside, if you look at it purely from a financial standpoint, in a country like India, owning a house absolutely does not make sense at this point of time. If you look at any neighborhood, let's say Sonal, so where do you live?
Sorry.
Okay, so are you aware of, what is the average property rate or property value of your house or in your neighborhood approximately?
So if you take a 2 BHK, it would rather range from 2 to 3 CR.
Okay, let's say it's 2 CR. And are you aware what would be the average rent that is paid to live in that same house?
So a neighboring house of mine has gone for 60,000 per month right now.
60,000 per month, right?
Yeah.
So 60,000 per month basically means on a yearly basis, how much are you getting?
I'm really slow at maths. I think it's 5 lakh, so it's 40,000 for 12 months.
Yeah, so it's approximately 7.2 lakhs.
Oh shit.
Yeah,
7.2 lakhs.
right. So let's say you're getting 7.2 lakhs on a 2 crore ka house. So what is the yield that you are getting? So 7.2 is basically the return that you get, okay, divided by the value of the property, that is 2 crore. So what is your yield or what is your rate of return from that? So 7.2 divided by 2 crores. So that is approximately 3.5%.
Right.
Right? So 3.5% is the rent that you pay to live in the same house that you could buy for 2 crore rupees, right? So, by paying just 60,000 rupees. Now, do you know what is the interest rate going on in India currently for housing loans? It's somewhere around 8 to 9%.
Yeah.
Okay, so if I am, let's say, buying a house, a 2 crore house, 8% is the sort of interest that I would be paying on it. So 8% on 2 crores basically means 16 lakh rupees. So 16 lakh rupees will be my interest payment. Forget about the capital repayment of 2 crores, but 16 lakh rupees every year I will have to pay just as the interest to live in that same house that I can rent for 7 lakh rupees a year. So what do you think? Does that make financial sense or not?
Yeah, but then if we consider India as a country right now, we don't really have that, 99-year lease, or some like, you can lease out your land or something of the sort instead of completely owning it. So maybe if we consider like Bombay, for example, and we own a house in Bombay rather than having a rental base, we surely have that edge. Or maybe, with the value of land probably appreciates over time. So maybe not in the 10-15 years, but maybe somewhere down the line, we have a better trade off.
So again, from a financial standpoint, it will not. But from
Yeah,
an emotional
emotional
standpoint,
standpoint.
yes, definitely. If you want to live in a house, if you want to purchase a house that you want to live in, you should
Yeah.
definitely go for it. But when should you go for it? Should you go for it as soon as you start earning, as soon as you start drawing a salary? No. You should
No.
think about buying a house when you are, let's say, 30 or 35, where you've, settled down in life. You have started a family, you know that you're going to be in this city, because today the world is so dynamic. People are not just moving cities, they are moving states and countries on a very fast basis. I mean, in 1 year, all your friends are going to be in Mumbai. The next year everybody is out of the country. So it is very important to get into that situation. And by the age of 30-35, with savings, with investments, you will also develop a good sort of corpus to make that down payment, to not take a very big loan which will cause you a financial burden. What usually happens in especially a country like India is, with the pressure of buying a house early on, as soon as you start earning, you take a loan as soon as you start earning. Let's say you draw a salary of 1 lakh rupees, you take a loan of 2 crores, 16 lakh rupees goes into your EMI or your interest payment, just the interest component. If you add the capital repayment, it is somewhere around 20 lakh rupees a year. So even if you draw a 1 crore ka salary, right, you pay 30% tax, you're left with 70 lakhs ka salary. 20 lakhs of that goes just in repaying that house. Rest 50 lakhs, you still have your entire family to take care of, your other expenses. So what happens is everything else in your life takes a back seat just because of buying that one property or buying that one house. So from a financial standpoint, you should at least try to postpone it as much as you can. But at the end of the day, of course, if you are going to live in a city, you should buy a house for yourself to live in.
Thank you so much.
Yeah. Thank you.
Anyone else have any?
Right. Any other questions, any other doubts, any other points to cover?
Does anybody have questions? You can ask. You can type it in the chat box or you can directly ask. Yeah. I guess everyone
I
has
guess
got
that, yeah, I
very
think
much
everyone.
information.
Okay. So I'll just touch base upon one last thing. So because the session was called 50 crores, I just realized that, I've not touched base on what is that 50 crores that I'm talking about, right? So I'll just share another calculation. Again, I know these are like very big figures and a lot of figures that I am showing you. But I mean, this opened my eyes, to be honest, when I was 16 in FY, and this is what has gotten me here today. So I would love, even if one of you ends up implementing this in life, that's going to be good enough for me. So this is basically a calculator on the sort of money that you can make over a period of time. Let's say we are talking about a 50 crore corpus that I want to make over my working life. Okay. And I start working at somewhere around the age of 25. So if I'm working till the age of 60, I have 35 years to work, right? So if I'm working for 35 years and I am doing any sort of monthly investment, which is yielding me somewhere around 14% every year, with just by investing 60,000 rupees or 56,000 rupees every month, I can reach that figure of 50 crores. I mean, does that seem like, I mean, can you understand, like with 56,000 rupees every month, you're reaching a figure of 50 crores in 35 years. Now, 56,000 can also seem a little bit too much. So let's say, my salary is not going to be constant every year, or the business income that I draw is not going to be constant every year. It usually increases at about 10-15% every year. So if I increase my investments by also 10% every year, then all I need is 20,886 rupees. If I start investing with 20,800 rupees every year, every month, and I increase it by just 10% every year. So I'm investing 20,000 rupees for the first year, 22,000 rupees for the next year, 23,000 rupees for the year after that. If I keep on doing that, I am actually going to make 50 crore rupees in my lifetime. I mean, it is absolutely crazy the sort of impact that power of compounding has over a longer period of time. I mean, just imagine 21,000 rupees leading you to 50 crores. That is something that just seems unreal. I mean, I'm sure 90% of you are thinking, क्या बकवास कर रहा है यार, छोड़ो सेशन खत्म करो, घर जाना है, बाहर जाना है मुझे कहीं. But I mean, I hope that even one of you take this for real. I mean, I'm not kidding around over here. This is the magic that investments have. This is the magic that is actually happening, and this has actually happened in the country for the last 25 years. If you look at some funds, I mean, I'm not recommending these funds as of now. Do not take this as any sort of recommendation, but I'm only showing this because these are the funds that have been in the country for the longest period of time. I mean, these have been in the economy for the last 30 years. So this is one Franklin Prima fund, wherein if you do just a 10,000 rupee investment every month, and this fund has been in existence for the last 30 years. So 10,000 rupees every month basically means 20,000 every year. If you have done that, if you've invested just 10,000 rupees in this fund every month since inception, since the last 30 years, your 36 lakh rupees of investments has become 16.5 crores. This has actually happened. People have actually made this money. This is, I mean, these are not Excel calculations that I'm showing you. These are real figures. This is actually happening in the country. This has actually happened in the last 30 years, and this is going to happen in the next 30 years. You double this 10,000 to 20,000 and you add that 10% increment, this 16.5 crores is going to become 75 impact. This is the sort of growth that we are seeing, we have seen, and we are going to see. The best time to invest was yesterday, the better time is today, and the worst time is going to be tomorrow, right? So that is what I leave you with. Be disciplined, be patient, be consistent, and just try it out. Just try it out with 100 rupees, with 500 rupees, with 1,000, whatever you can do. You will see the impact, you will see the magic, and I'm sure some of you will make that 50 crores, and you will remember me hopefully one day, 30 years down the line, that this guy had come, he had showed me this figure, just like I remember that gentleman who had come in when I was in FIJC. I for the start thought I am going to reach there. I'm already a good way down the line, and within the next 15 to 20 years, hopefully I'm going to reach that target. So I hope as well. And you take advantage of the magic that is for the. Thank you, Shah, and thank you, HR. Thank you guys for attending.
Thank you so much. So, on behalf of the BFM committee, I'd really like to thank you, Mr. Tirth Gala, for taking out your time and conducting such a wonderful and insightful session. So, our students really gained a lot of basic
Thank you.
knowledge regarding personal financing, and I'm hoping somewhere down the line these little aspects, stick with us. I would really like to thank our principal, Dr. Pooja Ramchandani, and our professors in charge, Dr. Shweta Singh and Mr. Vicky Karnani, for giving us such an stage in conducting this session. And lastly, thank you so much, everyone, for taking out your time and attending today's session.
Steve, it was an insightful session. Thank you so much. And I'm so happy that you are following the rule and you have given others also the tips. So thank you so much. Here's some network issue, I guess. So.
Yes, I guess.
We can stop recording sooner.
Yeah.